Real estate investing is a process that involves purchasing, managing, and selling properties to generate income or appreciation. It serves as a fundamental entry point to understanding the broader strategies and nuances of the real estate market. This introduction is crucial as it provides both new and seasoned investors with the foundational knowledge needed to navigate the often complex landscape of real estate investments. The significance of real estate investing lies in its potential for long-term wealth creation and portfolio diversification. Unlike stocks or bonds, real estate is a tangible asset that offers investors the opportunity to earn passive income through rental yields, appreciation of property value, and the benefits of leverage. Understanding the basics of real estate investing sets the stage for exploring deeper strategies and insider tips that can enhance an investor's potential for success. For instance, consider the story of a young professional who purchased a duplex as their first investment. Living in one unit and renting out the other not only offset the mortgage, but also provided a steady stream of income. Over time, as property values increased, they leveraged the equity to acquire additional properties, exemplifying the potential of intelligent real estate investing. Another example is the rise of short-term rental platforms like Airbnb, which provides an avenue for traditional landlords to maximize income from their properties by appealing to the tourism market. These examples showcase the real-world application of concepts that even novice investors can grasp and implement. However, real estate investing is not without its challenges. Market volatility, economic downturns, and regulatory changes can impact property values and rental income. Critics argue that real estate markets can be subject to speculative bubbles, leading to significant losses if not managed wisely. Access to capital can also be a barrier for many potential investors, highlighting the importance of strategies like partnerships and creative financing. Despite these challenges, the fundamentals of real estate investing connect deeply to other aspects of the topic, such as risk management, strategic planning, and financial acumen. A solid introduction to real estate investing establishes a necessary framework, empowering investors to identify opportunities, assess risks, and apply expert insights to achieve their investment goals. It paves the way for understanding the hidden secrets revealed by seasoned professionals, making it an indispensable part of the overall discussion on successful real estate investing. Understanding the basics of real estate investing is fundamental to unlocking the hidden secrets of this lucrative field. This aspect focuses on familiarizing oneself with the key concepts and terms that are foundational in navigating the real estate landscape. At its core, this involves understanding essential terminology like cash flow, equity, appreciation, and capitalization rate. Cash flow refers to the net income generated by a property after all expenses have been deducted. Equity represents the value of ownership in a property, while appreciation is the increase in the property's value over time. The capitalization rate, or cap rate, is a metric used to evaluate the return on investment of a real estate property. The significance of grasping these concepts cannot be overstated. These basics serve as the building blocks for analyzing potential investments and making informed decisions. A clear understanding is pivotal as it influences risk assessment, strategy development, and ultimately the profitability of any real estate endeavor. Knowing these terms equips investors with the tools needed to evaluate properties, negotiate deals, and anticipate market trends, making it an indispensable part of real estate investing. Consider the application of these concepts in the context of purchasing a rental property. An investor who understands cash flow can assess whether the rental income will cover mortgage payments and operating costs. Simultaneously, by calculating the cap rate, they can compare potential returns with other investment opportunities. Another example is the process of leveraging equity. Investors can use their equity in a property to secure loans to acquire additional properties, thus expanding their portfolio and increasing potential income streams. However, while these basics are crucial, it's important to note potential challenges and controversies surrounding them. Real estate markets are subject to fluctuations, which can affect appreciation rates and skew cash flow projections. Additionally, differing opinions exist on leveraging equity, as it can amplify both gains and losses, introducing a higher risk factor. These basic concepts are deeply interconnected with other aspects of real estate investing. For instance, understanding them aids in financing decisions, enhances negotiation skills, and supports the development of exit strategies. They influence everything from property selection to portfolio diversification and beyond. Mastery of these basics enables investors to uncover the hidden secrets of real estate, utilizing insider tips from experts more effectively. By building a solid foundation, investors position themselves to capitalize on opportunities and navigate the complexities of the market with greater confidence and competence. Finding opportunities in real estate investing involves identifying properties that hold promise for appreciation and return on investment. This concept is crucial because the ability to pinpoint promising properties can significantly impact the success and profitability of a real estate investment portfolio. It requires a keen understanding of market trends, location specifics, and potential growth areas to make informed decisions that maximize returns. The significance of identifying promising properties lies in its potential to transform a modest investment into a highly profitable venture. By recognizing undervalued or underdeveloped properties in strategic locations, investors can capitalize on market upswings and demand shifts. This skill separates successful real estate investors from those who struggle to generate substantial returns. Consider the example of an investor purchasing property in a neighborhood poised for redevelopment. Perhaps a new transit line is planned, or a major company is relocating nearby, which historically drives up property values due to increased demand. Another example might be identifying properties in historically undervalued regions that are experiencing an influx of young professionals, driving gentrification and, subsequently, property appreciation. Expert opinions emphasize the necessity of thorough research and due diligence. Real estate insiders often stress the importance of analyzing neighborhood statistics, such as crime rates, school quality, and access to amenities, as these factors can heavily influence property desirability and value. The use of technology and data analytics has further revolutionized this process, offering tools that can predict market movements and identify emerging hotspots with greater accuracy. However, this concept is not without challenges. Real estate markets are inherently unpredictable, influenced by fluctuating economic conditions, shifting demographic trends, and unforeseeable events like natural disasters or pandemics. Controversies may arise when speculations lead to market bubbles, resulting in significant financial loss during market corrections. Additionally, there is the ethical consideration of gentrification, where identifying opportunities might contribute to the displacement of long-standing communities. Identifying promising properties ties into broader aspects of real estate investing, such as risk assessment and portfolio diversification. It influences how investors allocate their resources and manage risks to ensure long-term financial growth. This ability not only enhances investment outcomes, but also fortifies an investor's position within the competitive real estate market. Understanding and leveraging this aspect effectively can lead to amplified success across the spectrum of real estate investment endeavors. Financing strategies in real estate investing refer to the methods and techniques investors use to secure the necessary capital for purchasing properties. This often involves leveraging resources such as bank loans, private lenders, partnerships, or even creative financing methods like seller financing or lease options. The key purpose of these strategies is to optimize the use of available funds to maximize investment returns while minimizing risk and personal capital outlay. The significance of financing strategies in real estate cannot be overstated. Effective financing is crucial as it directly influences an investor's ability to acquire properties, manage cash flow, and achieve desired profitability. Leveraging resources allows investors to expand their portfolios, enhance purchasing power, and potentially yield higher returns compared to using solely personal funds. Given the often substantial financial requirements in real estate, Mastering these strategies can be the difference between a stagnant and a thriving investment career. Consider, for example, an investor who utilizes a bank loan to purchase a rental property. By securing a mortgage with favorable terms, the investor can acquire the property with a fraction of the total cost up front. Over time, rental income can be used to service the debt, while the property's value appreciates. Another example involves forming a partnership, where multiple investors pool resources to purchase and manage larger, more lucrative properties, sharing the risks and rewards. Industry experts often advocate for strategic leveraging as a means to accelerate portfolio growth. The logic is that by using borrowed funds wisely, investors can control more assets and amplify their return on investment. However, it's essential to balance leverage with risk management to avoid overexposure or financial strain. Challenges and controversies do exist. Over-leveraging is a significant risk, as excessive debt can lead to financial difficulties, especially if market conditions change unexpectedly. Additionally, the reliance on external funding sources might limit an investor's decision-making autonomy or introduce complications if things don't go as planned. Alternative viewpoints suggest emphasizing cash purchases to avoid debt and build equity more conservatively. Financing strategies also tie deeply into other aspects of real estate investing, such as property selection, market analysis, and risk management. The choice of financing can affect these processes, influencing the types of properties an investor can pursue, the markets they can enter, and the strategies they employ. Thus, understanding and implementing effective financing strategies is a cornerstone of successful real estate investing, offering both opportunities and challenges that shape an investor's journey.